Hi guys, my name is Ang Tang with Tozy Capital. I'm very excited today to present our latest multifamily real estate deal. It's something that for those who have been following our journey, we haven't had many of these in the past year. In fact, the past 6 months, it's really been a drought. It's been a lot of close calls and near misses. And a lot of the offerings that we've seen in multifamily has been really great. It's done really, as an asset class, done really well. I like this one because it was also part of a near miss for us. And so I'm going to go through this presentation. Hopefully it'll take less than 30 minutes. Mark will be going into a lot more detail on the property as he's been closer to the operations team. And just as a reminder, this is a confidential offering. Feel free to let us know if you want to refer anybody, but just let us know, please. There's a lot more bullet points than you think. It's not that many pages, but we're going to go to the investment overview, the business plan, the terms, the cash flow, the financial summary, and then really go into the location and why I think this is a great opportunity, and then go into the property and go into our experience and highlight a little bit of sensitivity analysis for you guys. So the Regard is a multifamily investment offering comprising of a 319 unit building, 2013 vintage. So it's newer vintage, but it's mismanaged. It's a Class A neighborhood. Rent per square foot is 41% greater than the Regard's rents. So that means there's a lot of potential upside here if we can get to those our neighbors' rents. It's a light value add update, which means that there's not going to be that much complexity to this deal. We're buying it at a very great price. We're partnering with Frankfurter Group, who we partnered in our last multifamily deal, and they're proven experts and sponsors, and they were the one who were able to secure this great deal. And they have 8,500 combined, 8,500 units under management. And we're implementing best leasing strategies with Greystar Property Management, which have over 70,000 units under management. I've been to Texas a lot. Some of that's been for Bitcoin mining. Some of it's been for looking at deals with Mark. And I think Houston's one of these fast growing markets that obviously the pandemic and commodity prices have really heightened the value of oil, which is something that Tozy Capital has also invested in. But Houston is using those tailwinds. And I think there's going to be a lot of great opportunity in this specific location. Mark, I think this business plan is pretty easy. I just see a lot of low-hanging fruits here. Can you walk us through this strategy for the Regard?
Yeah, this is one that we're not going to overcomplicate. The fact is the comps, especially the neighbor where we want to be, they all have higher rents than us. This is a relatively new property and with a 2013 vintage. So it's great. We don't have to do a bunch of crazy renovation. The pipes aren't going to be bursting in the wintertime when it freezes. This should be a light lift. So in essence, what did happen was it was mismanaged. And if you just look at the current existing payroll, they're underpaying to get people who work there who aren't good enough. And so what we're going to do is hire better people and maybe add another couple positions so that we can have the quality, a Class A quality of sales team that can sell to the market that we want to sell to. And then the common areas can use a little sprucing up. There's 3 courtyards. There's a pool that has good bones, but we can make it nicer. And then there's 2 very underutilized, good-sized common areas outside that we'll be able to make a lot nicer and similar to what our competition has. Like I said, there's the comps have much higher rent. We'll just do a little bit of touch up, add some tech package, and then increase some of the amenities. And we think we can pretty quickly catch up on rent, or at least even just getting close to our competitors' rents does very well for us.
Yeah, there's a lot of table stakes here that isn't being implemented at all. And a lot of that is because the owner isn't really managing it a lot. They're not managing it well. So they're not focused on it. And I think when we were secret shopping our competitors as well as the Regard, we clearly saw a big difference. But the location is very similar. The location is actually in Regard, I think, much better. And I think that for 2013 vintage, is not much foundational effort here. It's more about the experience and creating these amenities, which our competitors have.
Yeah, I saw a question come in about more detail on the mismanagement. When I first went to secret shop it a couple weeks ago, I went to the front door and there was a sign on it that said, closed, come back in an hour. I did. I went right across the street to the competitor and I would have signed that lease if I was a legitimate, not secret shopping. But when I did come back, there were 4 people inside and the door was still locked, so they didn't unlock it properly. And right off the bat, that's a horrible thing to do, to close your doors during a prime leasing hour. The place could have been kept up better. There was trash in the hallways. It's the salesperson, they didn't make a connection. And if I'm someone who's working in the med center or one of these tech hubs close by or downtown, it wasn't a good fit for the sales team and our target market.
Mm-hmm. What does this business plan get us? It gets us pretty good results because it's a very undervalued property. We're basically buying below replacement costs. Our year 1, 2 cash and cash isn't our typical very high, but it's still 5.6% in a very nice market. The multiple is 1.6x targeted multiple, and our target IRR is 18%. It's going to be a 8% preferred return for those who are familiar with what that means or familiar with multifamily deals. Essentially means you will receive an 8% return on your invested capital before the sponsors receive anything. And then above the 8%, no catch up. There is a 70-30 split, 70% to investors, 30% to sponsors, only until you receive the 8% return. And we're targeting a 3-year hold period, allowing us to really quickly adapt our business plan and take it to market rate and potentially look for an opportunity.
And quick interruption there. One of our investors asks the following question. For new property investors, kindly review ARR and IRR. I'm not sure if they're saying what is the IRR for this particular investment, or they're asking, can you define IRR and just tell me what it means?
Yeah. So Mark, you're an accountant. I was in finance. IRR is really a function of your velocity of capital. I've always talked about what investing really means is about optimizing capital. And optimizing capital is shifting money from the future to the present, is allowing you to compound your money faster. And IRR is a measure of how quickly you return your capital and how much you return your capital. AAR is average annual return. So in this investor cash flow target model, you're essentially seeing 160% return over 3 years. So take that 100% out because that's your money. 61% is your 3-year return. And if you want to calculate AAR, just divide by the number of years. So that would be 20% AAR. Our target is 20% average annual returns for an investor, and IRR is around 18%, which just highlights sort of the acceleration of that capital. Providing quarterly distributions starting in Q3.
I'll let you go ahead with your presentation and the questions can come in a little later.
Okay. And I think this is a lot of the meat of the presentation, the financial summary. I don't want to get too stuck in this. Feel free to ask any questions here. And of course, this deck will be available as well as the pro forma for you guys, if you guys want to dig deep into the numbers. Essentially, we're buying the project at $65 million. We actually started at a little bit higher than that, $68 million. And so we were able to get it, reduce it a little bit further to our below market expectations. We're finalizing the loan. And of course, folks might have heard that interest rates have gone up. So we are doing a 3-year bridge loan as interest only, with a one point cap on that. So we'll have some security on if interest rates increase. The co-sponsor team, including the Frankfurter Group, will be adding 10% of the equity, and likely will be a little bit more. So this nets us a 1.6x investor multiple, as I said, 18% investor IR, and 20% average annual return for investors. I want to really go into I want to highlight what this project looks like. It's on the water and it's a very interesting location. That's the Regard. Next door is the Aspire at 610. It's a newly built, I think it's 2020, right? And newly acquired property that our partners were very close to acquiring. We actually made a bid on it, and we were outbid, and that's okay. We don't want to we don't want to throw money out at things that might not make sense. But we love the neighborhood. We love this potential area. And really, when you look at the Aspire 610, it's a Class A complex right across the street. I think our location is actually better because of the water feature we have. It sold a couple months ago, and we were missed out on it. But because we developed a great relationship going through this process, we were able to get a deal in with the broker, who's great friends with the seller. In fact, the seller is paying the broker for the fees in this case. And we get great first dibs and take it off market. So the Aspire sold as $240K a door, and we're getting it at $204 a door. So significant discount compared to the Aspire, and a lot of potential opportunity upside as well, because it's just right next door. And I want to highlight some of the rent comparables just to even highlight even further. Our current in-place rent per square foot is $1.63. Our target year one is $1.89. Aspire was $2.30. And the average of our comparables nearby within a 1 mile radius of the project is $2.30. So we are well behind in comparables. And with just a few fixes to the project, to the customer experience of the renters, we believe we can increase to market rate. And our projections aren't even to market rate, it's just below that still. So I just want to highlight again where this location is. It's right next to Energy Stadium. It's right next to Aspire, a project that we tried to buy. It's next to all these other great locations that are much higher in rent, but not necessarily a much better location. It's in fact, we're all kind of in a very similar kind of location. And we have great access to the freeway, 610 freeway, which is in Houston, a lot of traffic, but without traffic, probably 15, 20 minutes from downtown. So I'm not from Houston, but I think buying in any place, you always want to make sure that you have population growth, job growth, and crime decrease. Mark lives in Dallas, and he can speak a little bit more to why Houston and some of his projects that has done really well in Houston and why Houston is a great project.
Yeah, so Houston is this dynamic market. It's an extension of Texas. You know, initially, it was a big oil and gas town. It definitely made its name that way. You're familiar with NASA, which has the Johnson Space Center down there, very close by in Houston. And this property is just uniquely positioned. It's right by the Astrodome and now the NRG Stadium. But within 2 miles, you have the Texas Med Center, which is world-renowned. A couple of the locations, we'll talk more detail about this shortly, that there's a ton of jobs right there, great paying jobs, especially lately with the labor shortage. So that is 2 miles away. And then it's a magnet for new companies. So they've diversified significantly from the oil and gas. If right now it's great, oil and gas doing well, so that's some great tailwinds. But even without that, you still have a lot of high tech moving into Houston. HP recently relocated there, as well as other smaller companies. Texas is just very business friendly. I'm from Los Angeles, like many of you, and been here in Dallas for, 16 years or so. I'm starting to lose count. And I can't move back. It's too easy to live here. and to do business here. So we're going to keep seeing that influx. The workforce is highly educated. There's a few universities right there in Houston, but like Dallas, we attract people from other universities. Texas A&M is there, close by. Baylor's in between Dallas and Houston. You get a lot of folks from Oklahoma, OU, and Oklahoma State. Yeah, it's great. Houston is a great.
It would be probably second on my list to move to in Texas. If I could convince my parents to move to Texas. It's very hard to move out of California, even though taxes. And
I'm still partial to Dallas, but
I just see who was the number one. I want to highlight again this great potential location because it has a lot of, for those who've heard of the phrase path to progress, that means there's going to be a lot of potential development, or in this case, actual development that's already planned. You can read up on these developments. Right next door is Energy Stadium, right north to 610. We're only a couple miles from downtown, but we're also importantly next to the Texas Medical Center, a world-renowned center of higher education, medical research, and soon to be more commercial activity through a $3 billion upcoming development. And then right south of that is Texas University is planning a $200 million build out of additional campus space. So we're well suited to be capturing jobs that can't really be work from home, right? These jobs are service jobs, and these places are serve the best type of renters.
Actually, that last slide, it's University of Texas, not Texas University.
Okay.
And so UT Austin, UT Dallas are very big schools, and there's not a big presence unless you're in the medical field for the UT system in Houston. So this is actually a huge development, and it will be really great for Houston, especially us in close proximity.
Yeah, and now you guys get why it's called Regard Ed Med Center. And speaking of the Med Center, I just want to highlight in brief that this is going to be a very big deal. Not only is it already attracting a lot of jobs, it's creating a lot of new additional employment, which if you look at real estate, you want employment, you want higher educated employment, and that's coming, and that's already has happened. And so I think if we didn't do anything with this project, just the natural growth of the local area, local population, local demographic, I think that would create a lot of tailwind for this investment.
I'd also like to highlight, so MD Anderson is the preeminent cancer center in the world. You have people flying in from all over the US and the world to go there. And Memorial Hermann is also world-renowned, very popular.
Yeah. And the Regard Med Center is going to try to cater to this audience. I think there's going to be a lot of really clever things that we can do, knowing who our target demographic is, as that demographic expands and gravitates towards this local region. I believe it's a beautiful property on the outside. It's got great bones. There could be some improvement. Mark, you visited, there's a lot of space in the courtyards. There could be some more. I know that when we were cigarette shopping, they were telling us that there's gonna be some stuff here and there being improved. As in, I think they got wind of that they're getting sold, right?
But I don't think they did, but I do know that there's been enough grumbling that the amenities are crap and they're across the street. Neighbors are already nice and shiny, and they're going to get even nicer and shinier. I think that's all that was.
Yeah. And why do we keep talking negatively about this property? I think it's all about opportunity. Where is the opportunity? An investment in amenities and increasing the rent to potential market creates a lot of ROI, a lot of investment opportunity. And the amenities could use some work. But I think it's a beautiful property, 2013 vintage, as I said. The units are actually very spacious compared to the local other 1 bedrooms and 2 bedrooms. And I do think that there could be a little bit better. I think the model units could have stainless steel appliances and the upgraded laundry. There's a little bit here and there that seems off for this class and this type of property. And for folks who have the energy, the sponsor team who have the energy and the experience to do so, I think there's a lot of great upside here.
Yeah, this is great. Like it already has crown moldings, which is a Class A feature. So they spent the money on it, but then with the stainless steel appliances and a black unmatching stove, you can see there in the top left, you're kind of cutting yourself short there. It's those fine touches that are missing here that they're really doing themselves a disservice. And in fact, when we first started looking at this, rents decreased a little bit because of the condition of the deferred maintenance and then missing out when the market is getting nicer and these guys still have some minor things that weren't attended to.
Mm-hmm. That wasn't on purpose. And so to just reintroduce our team, we got myself, Mark Vinny, who is coming on as a capital partner, and then Yakov, who is the operational partner. And we're partnering with Yakov and Frankfurter Group for the second time since the last deal in Maple Haven. And I want to highlight their experience because they will be primarily the asset managers alongside Mark, and they have a tremendous amount of experience in 8,500 units, and they've had some recent pretty good full cycle cases as well. And of course, it's all going to be about turning the project around. Greystar has a lot of great experience in this location, in this general area, as well as in these type of projects or properties. And Mark did a really great job at some sensitive analysis. When we received some of the underwriting and we then validated and checked it and we worked on it ourselves, we wanted to be a little more conservative. And so the gray represents where we are in our underwriting. And of course, we'll have those pro forma in the offering room. But the yellow really highlights where the operations team, the guys who've been trying to buy Aspire alongside with us and have been knocking on the doors and checking all the data. They believe that the new release rental rates over time will be 481 above current rent. We're knocking that down by 100, and we feel very strongly that's very achievable, and that their more optimistic forecast is also very achievable, especially with macro trends providing some great tailwinds for Houston and the specific location near the Med Center. And I know folks will be asking about interest rates. Our current interest rate is 4.85. We will have a 1-point cap. And to the extent that why this is a 3-year bridge loan, this is a 3-year project. And I know somebody's asking why hold it for 3 years? Because that's where a lot of the value comes from. We're going to turn this around and create market rents. We're going to lose the loss. We can essentially get closer to our competitors. We're not projecting to be above our competitors. We're just getting to market and to closer. So our interest rates being 4.85, it doesn't really, because there's so much opportunity upside here, I think there's so much great value still. And then our exit cap rate, we're targeting a 4.5. That's generally not the sell cap of this area. And we believe that could be lower in a more compressed market. And then on our vacancy, generally these type of projects in this type of population generally have very low vacancy. We're forecasting 5% once stabilized, although over the first year, we'll have a little bit higher vacancy as we turn over units. So what's the timeline? We're opening the investment today. We'll likely have, can't promise, but likely have the docs to sign tomorrow. I know our team is hard at work on it as we speak. Funding deadline is June 6th. We're working on finalizing, closing the loan. It's a race against the clock because we want to make sure that the interest rates don't rise too much during this period of time. So we're closing property in June 10th, and we'll have first distributions for Q3 in the following month. And then we'll provide K1s to you guys on March 2023. For Maple Haven, the project that we partner with, we did provide K1s in March as well. And just to get into some quick FAQs, I know we'll have a lot of questions. This is a 506C. Unfortunately, we won't be accept non-accredited investors. We will be accepting self-directed IRAs, but we won't be able to accommodate for 1031 exchanges. Although we have helped several people with 1031 exchanges and other projects, we just need a little more advance notice, just giving a little bit tighter timeline. Real estate is not a typically illiquid investment. That generally is why you get to see such outsized returns because liquid investments generally command higher premium. But so I wouldn't expect that. First dividend check would be a quarterly check in essentially for the Q3 operation in October. And minimum investment is 100K. And then we'll have a deadline subscription in end of May. And then Mark will be providing updates on a quarterly basis to investors. And then we'll close the project on June 10th. And then just to highlight for those who don't know, bonus depreciation does allow us to get 100% of any property that has 5 to 10, 15 years shelf life. We probably deem around 20 to 30, 20, 25% of the project to have that shelf life, which allows us to essentially accelerate it to 100%. This accelerated bonus depreciation will probably only last this year. Next year, I believe, is going down to 80%. So buying property, investing in projects for 100% bonus depreciation, not saying that you receive 100% bonus depreciation, but we would expect probably close to 40 to 50% of your investment basis as a K1 loss, paper loss, helping you offset other passive income gains. And then finally, we do expect to invest more than 10% of the equity, and depending on how many investors we have. With that, I'll